Have a headline on our bulletin this morning which says oil crash sends US speculators fleeing at the fastest pace in 6 weeks. In early April, we had OPEC Plus coming in to support the market, and all we've seen is negative sentiment. So what is going on?
I think you're right about the OPEC Plus action causing some short covering. It has been a characteristic of the market this year that we've seen managed money erring on the negative side in terms of positioning on oil. And I think it's fair to say that we've had a few signals that have helped reinstate that negative outlook in terms of slightly more disappointing consumption data coming out of large important economies such as China. And also a view that's been revised. Certainly our in-house view has been revised on how much extra oil production is coming into the market in the latter half of 2023, which has the world seeing a stock build in the coming months. Although my personal view is that will give way to a stock draw later in the year, especially when the Asian seasonal demand kicks in towards the end of the year. However, both a view that there's more supply and less demand has some people now saying that the OPEC decision, which looked like a surprise, was maybe based on a view that has borne true, that we've seen slightly weaker fundamentals kick in. Now, whether that's worth Brent going all the way down to 75 and at some point last week into the very low 70s is open for debate. Of course, we are still in the process of releasing SPR in the USA. A lot has been made of the fact that the Americans didn't give the price signal that they had message that maybe might be forthcoming in terms of what a lot of people are referring to as the SPR put. And as a consequence, you are putting out questions now, which I saw your audience have answered roughly 50-50 on whether at the next OPEC ministerial meeting, OPEC Plus is going to be compelled to take yet more oil off the market. So to sum up, I guess my view of things is there is a slightly more disappointing view of demand and a more adequate view of supply that has given people more reassurance that there's adequate supply. It has especially manifested itself in diesel markets, where you can see the official data on speculative length. It is not speculative length, it is speculative shorts. People are positioning negative towards that diesel demand. All that against the backdrop of a year where we still think we're going to be growing in excess of 1.5, 1.6 million barrels a day, of which a good 2/3 is jet demand. And yet there is a view fundamentally that there is an adequate amount of oil in the market, despite the fact that oil's gone missing in places like Kurdistan, Nigeria, and force majeures, and various other concerns as well. And I think a couple of areas that have lent themselves to the to the supply position that are maybe a bit surprising is there seems to be more oil from the large northern Gulf state on the market, backed up by statements from Iran themselves. I think Iraq seems to have compensated for reduced or cancelled Kurdish exports to the north by exporting more from the south. And all in all, there seems to be a view that there's more oil to come from the US exports also.
Okay, well, I mean, on those fundamentals, Mike, and you mentioned obviously Chinese demand has been a bit less than people thought, and the trajectory, more importantly, might be weaker. But only a month ago, even as prices were sort of stable, people were saying, yes, but the second half, we're going to have to be prepared for, a tight market. We must be careful that we have enough supply, and we've got the spare capacity now within OPEC. Where on the ground in China now? What's being expected for a second half now, really? Q3, Q4? Do we have to wait till Q4 now to see any boost? Before it was like by June, we're going to be upwards all the way in China, no doubt.
Yes, I mean, I think it's the underpinning issues are still construction sector in China, as we've known ever since the Evergrande debacle has been weighing down on the market. And of course, that weighs on sectors such as cement and steel, construction and diesel demand. Where China has surprised to the upside, and the mobility data over the May Day weekend and the Golden Week sort of bore that out, is that gasoline demand in China is still pretty good. It's possibly just post-COVID mindset of people preferring to get into passenger cars instead of on public transport. The bit that's really missing from the Chinese demand equation is still long-haul jet travel, long-haul aviation. I said in a previous one of these calls that Beijing International Airport is still very much a quiet place with duty-free shops all closed. Now, that was a few weeks ago, may have changed, but I think it's fair to say globally and in China, domestic air travel is back to pre-pandemic levels, if not above in many places, but long-haul travel is not. And that is a very big chunk of the year-on-year demand that we're looking for. So for Q3, Q4, to answer your question, unless long-haul travel schedules are reinstated or flights added, there will be a gap in demand in that jet cut of the barrel. But the other one that's been revised downwards by most observers out there is diesel. Diesel obviously being the engine behind industry, and it's the industrial indicators that have been disappointing across the world, as opposed to the service sector, which is really looking extremely healthy. Now, some people argue that diesel is the service sector because FedEx and Amazon parcels get carried around on trucks that run on diesel. But for the most part, that is where people are revising diesel demand down to a point where year-on-year demand for diesel globally, 23 versus 22, is really down to just 100,000 or 200,000 barrels a day now in some people's minds, and it's gasoline that's picking up the slack. And you can see that manifest itself in the cracks. Gasoline looking healthier and diesel not. But another thing that's happening in global supply demand is refining margins have moved to a point now where people are talking about run cuts in certain areas, certainly for simple capacity, and that's normally a big normalizer. I mean, markets have a habit of fixing themselves. So in a world where there is a bit too much diesel around, including Russian diesel afloat, of course, refiners back off, and then suddenly that equation is fixed. The final thing that's weighing down on oil is gas, because if you pull up a gas price and you see the US Henry Hub at just above $2 per MMBTU, that's obviously been weak all along. But the international price of LNG has also come down and really moved in a very different way. So after the OPEC announcement that took Brent to $86, $87 a barrel, gas didn't really go with oil at that point, and gas has been weak to a point where LNG is now competitive with low sulfur fuel into utilities. And we have to remind ourselves that a large amount of oil demand has been boosted by oil displacing LNG in power generation. And LNG now has a chance of featuring in those South and Southeast Asian economies where it has been shunned for the best part of the last year and a half.
You mentioned Iran and supply. Let's look at the supply equation. There doesn't seem to be any panic about enough supply for the world at the moment. But there has been a lot of PR, at least, talk of, Iran is now hitting new records and production and exports. How positive or accurate can we feel about that? Is it more than what's really happening on the ground?
It's a bit tough to say because, as sitting in this company I'm working for, I don't have first-hand information, of course. But we have seen the statements that you echoed in your daily news bulletins of Tehran expressing an update that they are exporting more oil than ever, and one can try and put two and two together in terms of those destinations for that oil, notably China, that the market is perhaps not quite as strong for the heavier end of the crude barrel as you might expect at a time when China should be gearing up for bitumen season and greater demand later in the year. As for Iraq, that's a bit more tangible because, of course, we've all seen the ruling in the court in Paris playing out over the export of Kurdish crude to the north. And there are many companies, some of them listed, of course, who've come out with declarations of their production being shut in for the best part now of 45 days or so. And those flows have historically amounted to 400,000 barrels a day plus. So I saw something anecdotal, which I can't ascribe to anybody, so take it with a pinch of salt here, but that it does appear like the overall balance for the country of Iraq has been addressed in terms of Iraq simply dipping into their spare quota that Christoph was talking about before, and exporting a little more to the south. If that is indeed the case, of course, that will then serve to settle nerves over supplies in the north. And it would also jive perhaps with some talk that the Chinese had undernominated for liftings from other GCC producers in the previous month. It is difficult to do a mass balance on this, of course, but I think it is fair to say that the best part of 400,000 barrels a day of production has been progressively shut in. In some cases, there was buffer in the system, so certain Kurdish fields would have had spare capacity. And of course, they would be heavily incentivized to fill up all refining capacity domestically, both in northern Iraq and in the Kurdish refinery, in order to at least take up some of that slack and not leave it in the ground as lost production. But all in all, I think the point I was trying to make at the beginning of this call was that compared to maybe a month ago, there has been less oil that's gone missing from that country as a whole, including Kurdistan, than maybe was the case in people's minds this time last month.
Just talking about in terms of supply, we talked about Iran, Russia, anything different? We're in the middle of the second quarter. Anything different you see as a trend going forward from now on compared to last year, where we've seen Russian product and crude continue to flow to new directions maybe, but that 500,000 cut also not necessarily evident in the market yet?
It's awfully hard to tell. Again, it's all secondhand information because we're not participating in many of these flows, but it would appear that the cuts announced by Alexander Novak about a month ago in sympathy with the OPEC plus cuts and just a few days after has yet to be substantiated. There was a consensus in the market that they would go through with it. And of course, the question, as always with Russian, is will it be crude or will it be products? Because Russian products exports are substantial also. I think it's fair to say that we've had a very large accumulation on the water of Russian product in particular, both fuel and diesel, and to a much lesser extent naphtha. Those are the three main products that come out of Russian ports. And that's been necessitated by the realignment after Europe banned all imports with their last round of measures, whereby that oil now has to flow 20, 30 days longer voyages towards the east. But it's not just been sitting on the water in transit, because that would just mean 20, 30 days of stock build. In many cases, there's been the indecision around where do we send this oil, or will it find a market, a buyer which is happy to be assured via the necessary attestations that the price cap has indeed been observed or not. And the slice of the market, so the share of the market that has been willing to take Russian oil without that attestation, without having some confirmation, is finite, of course. And we have to remind ourselves it's not the refiner or the consumer of the diesel fuel or naphtha that is really on the chopping block here. It's the service providers. In some cases, in terms of insurance, certainly, it's very hard to find a service provider that doesn't have some sort of nexus to the G7. So it's insurance, it's banking, and it's shipping. And we still don't have a world which has figured out a way of making Russian oil flow to those markets that are willing to take it and accept the risks that go with breaching price cap. Just to remind, if you are buying or selling Russian oil in excess of the price cap, which for diesel has been the case for much of the last few months, you have to find a shipping company, an insurance company, and a bank that are willing to live with the potential consequences of sanction by G7. And that is not for everyone. So I think the amount of Russian oil on the water is still a very big component. Of course, it serves as a reassuring factor, to go to Christoph's train of thought, that it's there as supply will come to market one day. But that's been the major stock change in the last few months, along with a continued high inventory set in China. Everywhere else in the world, the inventories are actually relatively lean.
Mike, I mean, on that sort of revisions of demand, if you like, I mean, OPEC themselves, I think their recent forecast is 1.7 global demand for the year. You've got the IEA still being a bit more bullish, despite the signals we've had on fundamentals, on China growth, etc. Why are we seeing still quite a divergence of opinion on demand going forward, do you think? And secondly, I want to know if you're seeing any reverberation in Asia from this US debt thing. Are people nervous? Are all markets nervous, etc.?
On your last question, a very short answer, no. I think people assume the US will resolve it, as was the case in 2011, when most people in financial markets in Asia said, well, what was that all about? But Christoph has shed some light on the complexities there. So, I mean, let's hope it goes away. On the demand outlook, I think consensus, I mean, as it should, as we come towards the middle of the year, is converging on that OPEC level of 1.7 million barrels a day, year-on-year demand growth. But we have to remind ourselves that almost exactly half of that is in the bag in terms of domestic air travel. So that's not really the variable. The big variable is diesel demand. And on that one, people's estimates are still all over the show. And it depends a lot on inventory policy in the one place I mentioned before that has inventory, which is China. And that's closely linked, of course, to government policy. And some of the signals there have been out of tune with precedent. At the end of last year, when there was this big edict to export more, that appeared to be a head of party Congress effort to boost the trade balance in some way. So, I mean, I've always been on the bullish side of the spectrum, and Christoph on the other end, of course, when it comes to China. I think there is a seasonal uptick in Asian demand that always happens, just down to winter demand and the nature of the Asian market, which will give the year-to-date lagging demand year-on-year a big boost come Q4. I do see a deficit, all things being equal, even if OPEC don't take extra oil off the markets in early June, which, as Christoph said, they might. So I think Q3 we could flip from being stock build mode to being in a stock draw mode again. And on that basis, I think the market had priced in that forward stock draw, and then started changing their mind when it came to light that demand in the short term is a little disappointing. But I haven't seen any really major needle moving disappointment in demand that justifies the market getting out of length, as would be suggested by the sell-off from $86, $87 down to $72.50 on Thursday night. It feels a lot, and therefore we tend to look at money markets to explain this instead. So it's rather than looking at oil supply demand, which we focused on in this call, I think there's more of a macro view there on just negative sentiment around GDP, fear of recession, and people shifting money wholesale out of oil, which has in some cases served as an inflation hedge, to people that maybe want to deploy that money elsewhere.
Yeah, as you said, I mean, we saw Warren Buffett announcing in the Q1 they withdrew, I don't know how many, several $1 billion just from the market itself. So there is a nervousness around generally. But it's the China storage point that you made, it has obviously massive storage, the biggest in the world. But there was some comments last week on our show that is actually almost at capacity right now. Is that the case, do you think? There's very little sort of net storage at the moment in the system, because they've been buying quite a bit of oil, haven't they, in Q1?
There's actually no such thing as official data, right? So there's commercial storage in the hands of private and public government companies. There's strategic storage, and then there's on the water oil in terms of ships waiting to discharge or water or oil on the way. And then, of course, there's oil held in title, because a lot of the Chinese trading companies have extensive trading networks that also possess storage in OECD. So if you take all that together, it's difficult to say that it's completely full, but inventories are definitely high by what we can piece together. Yeah.